Banks, people, the rise, the fall, the collapse of America's institutionalized banks. Let's get it. What's going on, y'all? It's Dr. Black Wealth. Listen, we're going to get right into it. We're talking about banks, right? You've seen the news, what's going on with Silicon Valley banks, right? So before I kind of jump into the present of Silicon Valley, right, especially as it relates to our people, what that means for Americans, but more specifically Black Americans, let me kind of just give you a history of what banks is and just how banks work, right? So banks are the strong institutions that kind of centralize the world's economy, right? So just like how any other institution or entrepreneur or business go out here and make money, banks makes money too. And they do it what's called fractional banking. That is controlled by the Fed, right? And some by the Fed mostly in the way that banks do banking. And so what happens is a typical American makes deposits into a bank. So whether you get paid once a week, twice a month, every other week, whatever that looks like, when your money hits a bank account, the bank has to keep what's called a reserve, and normally is 10% of what the depositors deposit into the bank. So if we get $100, right, 10%, they'll be keeping $10 in the bank that allow them to leverage the other $90 for loans. And they lend it out to people who buy mortgages, credit cards, right? Personal loans, business loans, home equity loans, any type of loan you can get at a bank is leveraged money from a mass group of depositors that they do lending to. So once you sit down and you say, hey, I got good credit, I have my income, right? Because in order to get a loan, the banks want to ensure that you can pay the money that they're lending you back. And so basically that money comes from a pool of the many depositors in the bank, and they lend it out. It's called fractional banking. Once that happens, the banks then charge interest. The interest on the money that you're paying. So when you look at your mortgage statement, for example, right, you have the principal of the loan that's being conducted, and then you have what's called the interest rate that you're end up paying, right? That interest is how the banks make money. Outside of lending money, the banks also leverage their capital by investing in other capitals to grow the bank's money, right? So that the bank can make money and the bank can be a strong institutionalized bank for extra lending, right? And so that's how banks essentially how they work, right? So when you put your money into a savings account and you're earning at today's rates, it's like less than 1%. On the money that you're earning, well, the banks is earning way more than that based off the money that they're lending off of your money. That's how it works. All right, so a little back in history, right? So right after the Civil War, there was a bank called Freedmen Savings Bank that was established right after the Civil War. And it was used to hold a lot of the free blacks' money who were able to kind of like travel, all the blacks that were free that had money, right? So you think about the blacks in that time period, right after the Civil War, a lot of people who fought in the war, their money went into that bank, things of that nature. Right, so this is the bank and the era, if you want to get into it, where black people trust in banks diminished. So if you listen to our grandparents who keep money in a tomato garden or in a mattress, this is kind of where that mindset came from as it relates to blacks and banking. After some time that the bank had been established, it had many branches all across, right? And they were going on a decline. And right after the assassination of Lincoln is when the bank started to really go downhill, and they ended up closing the bank. And when they closed the bank, right, it closed with over 61,000 people who had money attached to this bank that all black people, and they seen like a fraction of the money that they deposit, right? Because it was just seized by Congress, and all that money was taken, and that started the breakdown of people trusting banks or not trusting banks, and American government banks at that, and that's where you get people who now save their money in different avenues, cash, right? That's not really safe, allocated to grow your money. So now we jump into today where we're talking about the Silicon Valley Bank, right? And so you have to look at the different types of banks that we have out in America. You have big banks, right? So like your Bank of America, your Chase, your Wells Fargo. Those are what's called big banks. Then you have your credit union banks that are more so for members only. And then you have small and local and regional banks, right? So in order to not create a point where the big banks are in control of all America's money, you really need these small and regional and local and credit unions and community banks to try to keep money flowing and provide access to people to be able to establish banking relationships. So Silicon Valley Bank was a big bank that's out in Silicon Valley that was used to for people who were in that tech industry that was looking for capital and things of that nature. Well, what ended up happening is the bank made some bad investment decisions, basically, that began the collapse of, not necessarily collapse, but the downturn of just their investments in that. And so here's one of those things where social media, I don't know, may be good, may not be good. I guess it depends on who's looking at it. But what happened was once the depositors or the people who bank with this bank got hold of it, right? So a lot of people went in there and they was trying to extract almost 42 billion or $1 million out of this bank at one time, right? And the bank was over leveraged, right? Because they don't have the cash really just sitting there like that. But the people were trying to pull out their money, right? And so the FDIC came in, took control of the bank to insure the deposits. But the FDIC only insures up to $250,000. And then that's when the government quickly came in and insured everybody's deposits and money and really saved this bank. This is like the first the first biggest collapse that we've seen in a long time, right? So, and that's just what happens with bank, right? Based off the business model of how the bank was, and people going in there and seizing their deposits and coming out to pull cash out, and they're being over leveraged. They didn't have the money to cover it, right? So when you look at banks, right, you want to kind of diversify. In my opinion, I'm not saying that banks are good or bad, right? Or we shouldn't use them or we shouldn't use it, but we should know how these things work so we always have a diversified portfolio, if you will, about banks, right? Having your money in different places, different banking institutions. It's probably not good for you to just bank with one bank, right? You might want to have more than one bank, right? And you may not want to have over $250,000 in one account, right? So you can open up multiple accounts with said same bank. Let's say if you bank with maybe Federal, you can open up multiple checking accounts, and you can have up to $250,000 per account, so that you can make sure that your money is insured, so that if something like this was to happen, you could pull your cash out. Right. And then you also just want to diversify your money, other investments, business opportunities, things of that nature to grow it. Don't just focus on the bank growing it, because the bank's going to grow their money. They're not really concerned about your money except for getting you to, that's why the ads come out for you to do savings deposits, Christmas clubs and things of that nature. Because the more that the banks can get you to save money, the more that the banks can leverage your money for them to make more money. Well, you need to be able to do the same thing. Talk to different business owners, invest in private companies, invest in public stock companies, right? Invest in just bonds, right? Treasury, invest in real estate, right? Diversify your money, and don't just leave it up to chance with one bank. That's what I will tell you, right? So the bank system, it might be failing, might not be failing. That's up for opinions, and I'm not here to get into that. But we're going to lay out the facts of what happened with Silicon Valley, and then what you should do with your money, as far as how you need to be more aware of what's going on with your money. As we make more money, we need to be conscious of what we do and how we do it, and making sure everything is spread across so that we're not affected by one bank collapse, because it could happen, as we see.